This is Ken Kabula from the Mid-Michigan chapter, and we sponsor this roundtable program once a month. This is our annual awards night, and we've invited all of our guest presenters as well as the regular knights to come this evening and maybe win a prize or two and have a little bit of fun in the process. We hope to give you the names of 3 or 4 stocks that we really think are very interesting at this particular moment in time. Let me introduce to you the folks that are in our back room tonight. We have our guest damsels, Kim Butcher from Evansville, Illinois.
Indiana.
What did I say, Kim? I said Illinois, didn't I?
You did.
It'd be an improvement.
And Ann Manning from Houston, and I know that's in Texas, right, Ann?
Yes.
We're glad to have both of you with us. One of the other directors in the Mid-Michigan chapter has been one of our guests at various times. That's Herb Lemkohl. Herb's from the Northwest Lower Peninsula in Traverse City. Beautiful Traverse City, one of the nicest places on earth. Hi, how are you doing, Herb?
I'm doing great, and welcome to everybody.
And then, of course, we have our regular knights with us this evening. You can see these pictures on this front page. We have Cy Lynch from Atlanta, Hugh McManus from Southern California, Pasadena, I think. We have Mark Robertson, although I was telling Mark before the program began, I would never have recognized him in that yellow suit and that hat with the white headband on it, but that indeed is Mark. And myself from up around Saginaw Bay area in Michigan. This is February 26th, and if you have questions about what's going on at the roundtable, or if you'd like us to send you a reminder and are not currently getting a reminder, don't be afraid to drop me an email and we'll get you on the reminder list for future roundtable programs. Mark, why don't you go to our disclaimer slide if you could.
I did want to point out that one of our reigning Groundhog champions, Nick Strategos, there on the right, would have loved to be with us, but he's unable to join us tonight.
Folks, this is an educational demonstration. It might sound like we're recommending stocks occasionally, but we're really not. We're suggesting that you take the names that we give you and go home and study them. We do have a purpose in what we're trying to do at the round table, but that purpose is not to make specific recommendations to buy or to sell particular stocks. We're doing everything as an educational demonstration, and the point that we're trying to make, and Mark, if you can click the slides again, the point that we're trying to make is to create a portfolio that will at some point begin to maintain a relative long-term relative return of plus 5%. What that means is that we'd like to beat the market long-term by 5 points. We'd also like to make our positive or our winning stocks, that list longer than the list of losing stocks. We're aiming to have 60 to 70% outperformers to the total stock market index. We're comparing everything to the Wilshire 5000. We're not afraid to move into non-core stocks, although the majority of our stocks will be traditional, better investing type of stocks. We're adding these stocks on a monthly basis to a tracking portfolio, and we're putting it up there for everybody to see. Tonight you can see our agenda. We're going to be looking at the scoreboard and perhaps make a challenge to a stock or two. Mark has some awards to give throughout the evening for best selections all time, best picture, and we are going to make some particular presentations during the evening also. Because we have a lot of folks here this evening, we're going to try to keep our presentations to no more than 4 or 5 minutes per stock, and we're going to end with the best performance results. The Oscar for that will be given at the end of the evening. We're getting some feedback from somebody in the back room, so if you can mute when you're not talking. I'm going to turn this whole thing over to my friend Mark. And Mark, why don't you take it away? Do you have a challenge for us to start with tonight?
Actually, we don't. We're going to just go ahead and dive into the performance of the portfolio. Good evening, everybody. Again, an abbreviated session on this also, but what we want to do here is just make the point that we've made some pretty good progress here over the last year. We should all be happy with the fact that our accuracy is now up over 50% after wallowing down in that 30 to 40% range for some period of time. And we have had a number of very successful selections this year. And the long-term goal is, as shown there, we do want to get to the point where we would be up in that 5 percentage point range. So this is the long-term goal, to outperform the market. We'd obviously be happy if we can get anywhere into the zone here. So the situation's been pretty good over the last year or so, and we hope to see this very powerful trend continue. And one of the themes that we do like to leave the audience with at all times, and again, I'm not going to try to run too long, try to behave like Seth or anything like that, but I think Cy Lynch says it best when he says sometimes it takes time for our approach to investing to work out when we're picking stuff that's pretty good, in pretty good position, pretty undervalued, but sometimes it takes time for the market to catch up and recognize value, and it always pays to pay attention to that. With that, we'll go into a look at the tracking portfolio that Ken described. Again, don't want to spend too much time on it other than to point out that it is available at any time at this public link that you see here, so you can check the roundtable tracking portfolio at any time, and it requires a little bit of decoding. Some of our participating knights, like Hugh, every once in a while will fall into a state of infatuation with a stock or two, and you see that Walgreens and Staples has been selected 7 times each. Every month when we do this, we place $1,000 into the stocks that are selected. So Walgreens, with 7 selections, has actually had $7,000 put into it, and you can see that it is now worth a little over $9,000. So that's the kind of decoding that you have to do going down the list. For example, Vera Bradley, 3-time selection, which you can see here, is just a little bit under $3,000. So that's how you break down that list. And again, these have been our favorites over the years. By the way, a little bit of foreshadowing, that's only 2 portfolio recovery positions. Any questions or anything, any comments on that from anybody?
I see, Mark, that Malcolm just asked that each new stock or each new selection is a $1,000 input as opposed to being a closed portfolio that operates on internal capital.
No, it's more like a mutual fund, if you want to think of it that way. Brand new capital coming along with every selection.
Right. And when we close a position, we do not reinvest those funds.
No, we don't. We basically cash the position out and track it on performance tracking.
Mark Ann Newman wants to know how many times has BioReference Labs been chosen, and if you look at the top of this slide, you'll see a 5X, and following that 5X is Cisco, Cognizant, BioReference Labs, and Landauer. So those 4 stocks have been chosen 5 times each.
And obviously we're pretty happy about BioReference Labs and how it's done over the last couple of years. And by the way, it still looks pretty good. It's actually come back a little bit into the mid-20s. All right, so with that, we want to keep things rolling here tonight. Let's go ahead and make our first award of the evening, and it goes to my friend Ken Kabula for the best selection of the year. It was a dead heat between Ken and Ann, with the same stock, by the way. Really tight here on the relative performance. Ken selecting it in April and Ann selecting it in January, so they both had extremely powerful performance. But you can see why Ken Kabula and Hugh McManus were kind of slugging it out for the lead this year. They're showing up quite a bit there in the top end of the top performing selections for 2012. So for 2012, it's portfolio recovery, thanks to Ken. And yeah, more foreshadowing, Staples sneaking in there. By the way, Staples wouldn't have been anywhere near this list a month ago, but they had quite a surge. that Mr. McManus has, much like someone from Southern California with a surfboard, having a pretty good time with a couple of his stocks there, including this one here. These both came out of nowhere to be two of the top performing picks over the trailing 12-month period. So Mr. McManus should be smiling.
He is.
And the
I don't really care when it happens. I just care that it's
Excellent.
And a point to note on that, Mark, before you leave, not only is patience necessary, but you mentioned Staples and jumping onto the leaderboard in the last month. There are certainly stocks that, when they begin an upward trajectory, continue that steadily for a while, but frequently, particularly ones such as Staples, that sits and apparently languishes for a year, 2 years or so. When it decides to move, frequently it moves quickly. So again, be very careful about saying, I'll just sit around and wait till something happens to a stock, or I'm going to sell a stock that hasn't done anything for a year or two, because you may miss the good month.
I think that's great advice.
I also, Mark, like to remind myself that if I listen carefully to some of the talk that goes on at these roundtables, twice I can remember Hugh telling me that if the other two office companies decide to do almost anything in their business model, that will only benefit Staples. And what caused Staples to take this deep jump right now is the fact that Office Max and Office Depot are suggesting that they're going to merge with each other. So Hugh, you've done good, Hugh. Okay.
And I believe, correct me if I'm wrong here, he's also operating under the possibility that Staples will go private at a much higher than $10 a share.
Yeah, the nice thing about Staples is that it's a company, really, because it's public. It has a short-term horizon, but it really has a longer-term business model. So it's not going to recover fully until the economy starts to recover, which is, the economy is recovering, but back to where it was before. That's going to take time. So it's possible if somebody sees that, they could jump in, buy it, and extract the necessary value out of it. Send it public again in 3 or 4 years.
Absolutely. All right, so let's go ahead, tip our hat to Ken. Ken, make a little room on the mantle for that first statue of the evening, and we'll press on.
Sounds good. Thank you.
Okay, let's go ahead and start with one of my favorite stock pickers and one of my favorite stocks right now. I'm going to join in with Ann in this month, and both of us like Qualcomm. So Ann, this is my picture of Qualcomm. Value Line doesn't like quite as much, but why don't you go ahead and take it away? I will point out to listeners that Qualcomm is the featured stock at Manifest Investing this month, so it's the Solomon Select feature, so you can go read what I think right there on the second click down on the home page. Why don't you go ahead, Ann?
Okay, I picked Qualcomm because every list I kept pulling up in Manifest had it on there. Tin Cup, Challenge Club, Manifest 40, they all had it on there. So that's where I started from. For those of you who may not know what Qualcomm does, they make the chips that run our apps and graphics on the smartphones and tablets. They're number one in their market share. They recently had a shortage of one of their products, and they have solved that problem by getting a different manufacturing facility. And they're well positioned in emerging markets. And of their competitors, they have on the Manifest Investing site, they had a better potential growth, better financial strength, better quality, and par than any of their competitors. And if you want to go on Manifest, Mark has done a great job this last month talking about this. You want to look at the different posts, and it can catch you up on the different things. I agree with Mark on the value line. I don't understand why their projections are so low, and I find myself in the position that I don't agree with them. And obviously they know more than I do, but I don't understand where they're coming down up with such low projections. On my projections, I projected 14% sales growth and 12% earnings per share growth, which puts me really just a little bit above what Value Line has on the earnings per share, but way below what Manifest is. So I'm not quite sure why we have such a difference here. Maybe Mark can address that in a little bit. But
Well, I would just point out, Ann, that apparently Morningstar and Standard & Poor's agrees with us. So
okay.
that's kind of where you see that.
Yeah, I didn't really have time to get into that, but I didn't see any reason not to project what I had projected. Their net profit margin is their pre-tax profit margin leads their peers, and also their return on equity is very good, and they have no debt, which for a company this size is pretty incredible, I think. Did you want to talk about the other one, Mark?
Yeah, we can just point out that this is obviously a company that's maturing, getting larger. It's a natural thing for the PE to be coming down. I think 2009, because of a hiccup in the earnings, you can probably pretty much ignore this peak. And what you see is just a company that is maturing and settling into kind of a landing pattern, somewhere in that high teens, perhaps as much as 20 on average. So, again, the PE that Ann is assuming, the PE that most of the research services are using, pretty normal, high teens, maybe 20-ish. And here's Ann's bottom line.
Yeah, I mean, I think this is great numbers for a large company. And you can't do much better than that because most of them don't get this high.
And I went ahead and just to reinforce some of what Ann is saying, what we see as a company that seems to benefit from whoever wins in the competitive wars of, the new tablets, the new notebooks, the new phones with computers on them, phones that are computers. But one of the things that we see here that I find quite compelling is that Qualcomm's quality is improving over time, but then also this kind of double sign of strength here. The stock price has been going up. And normally when a stock price goes up, the return goes down in proportional to it. Well, this just tells you that the underlying fundamentals of this company are consistently getting stronger, because that's the only way that return forecast can continue to go up during a period while the stock price is going up like that. So a lot of good stuff here. Read up on it. Go back and look at do your own homework. But Qualcomm looks pretty good to us. We'd like to add it to the roundtable tracking portfolio. Good stuff. Thanks, Ann. Well, let's go ahead with our second statue of the night. This is kind of like the first one, only in this case we're looking back at the stocks that were not just selected within the last year, but over the last 3-year period. And we have another repeat winner, Mr. Kavula. And it happens to be the stock from the last year, Portfolio Recovery, with its extremely strong performance, but you get kind of a feel for some of the stocks that have made contributions over the last 2 or 3 years. And a favorite that we've talked about here a few times, this MWIV is a worthy study, Veterinarian Supply Company. And TJX continues. This is a closed position, so it's in pretty strong running. If there were a Hall of Fame, that pick is in it. But once again, we see that guy who shall go nameless out in Pasadena creeping up on the board again here. And pretty much everybody's got one on that all-time list over the last 2 to 3 years. So congratulations again, Ken. You'll have to make a lot of room on the mantle tonight.
Something else to dust, boy.
You say that. I just dusted my desk today. All right, so with that, let's turn to the Evansville part of the team. That is Evansville, Indiana. That's especially important during Hoosier time.
Exactly.
And take it away, Kim.
All right. Well, my stock tonight for everyone to consider would be McGraw-Hill Companies, MHP. Now, McGraw-Hill had 2 divisions, their financial division and their education division, and their education division was actually sold off, and it was sold to Apollo Global Management for $2.5 billion, yes, I did say billion dollars, and this will be anticipated to be closing at the end of this first quarter in 2013. And they have, McGraw-Hill has got this growth and value plan going on to help reduce their costs. And what they've been doing is they have given back to shareholders by repurchases $1.8 billion at an average price of $44.21 a share. They gave the shareholders a special dividend in December of $2.50 per share, and they have also increased their dividend. And most all of us like those dividends, and they are one of the dividend achievers because they've had dividends they've been paying out for over 44 years. Next slide. Now this is from their fourth quarter earnings call, that this is where they feel that their financial division, just separate, is going to be with their guidance. So you can see there, and they're anticipating high single digits for their revenue growth and their adjusted earnings per share of approximately $3.10 to $3.20. Next slide. Now, one thing that you need to know here is this value line came from February the 8th, and if you look at the price, it was $57.18, near its 52-week high. Well, actually, it's really interesting because on February the 4th, the U.S. government has decided to sue McGraw-Hill because they feel that they disregarded the credit risk of mortgage banks during the housing boom to win business. Well, since then, the stock price has fallen to, it closed today at $45.87, which is at least a 20+% drop in the stock price. So I'm thinking that this would really be a great opportunity to get into a great company because they're going to the Morningstar side. I looked up, their return on invested capital is over 25% and the return on equity is over 43%. So this company is very doing quite well, and they've got some great cash flow going on. Now it's kind of interesting to be able to make judgments because if you look in their 2015-2017 projection box, it says CTEX, and this is all related to their knowing that they were going to be, they thought they were going to spin off the education division, and instead they have sold it off. So now I actually have value lines saved, and these value lines have been like this for the last 3 reports. But if we go back to how we talked about a triple play, the PE from the last value line that I found that had an actual PE ratio, when the stock price was down near $45 a share, the PE was at about 14. And if you can see, the trailing PE is 18 and the median 18. So guess what? That's a lot lower. And in the triple play with Nicholson, you want the stock price to be hurting a bit. And yeah, I'd say a drop in stock price of about 20 to 25% is there. But if you look at their operating margins, ever since the recession ended in mid-09, you can see that it was 24.9, 23.9, but it's steadily going up, 25.3, 25.5, and 27. So it is one of those candidates with the triple play. Now the financial division has also got a joint venture with the CME group, and they're going to be the largest provider of financial benchmarks out there, and they're going to be making all kinds of new indexes for those financial institutions who want to buy into them. So that would be a reoccurring revenue rate that would be pretty good, I'm guessing. I'm thinking, in my judgment. The other thing is that with all their other divisions have been very, very profitable by that fourth quarter handout that they had in the profitable, that the financial division itself had 11% revenue of organic growth and an extra 2% growth from the acquisitions that they have done. So even though the stock price does not look very good, I'm thinking it could be giving me a great margin of safety right now. I do realize with what's going on with the government wanting to sue them, and there are some of the states are filing suit against them also, so the litigation against the company is going to be depressing the price right now. So it'll be interesting to see what happens. But if we do a real simple calculation, if we take it from the Legends box, the $16 times cash flow per share, you can write that out, Mark, 16, and we multiply that by the cash flow per share if they just expected it to be $4.10.
Yep.
I think we would all be pretty happy with that stock price.
Fairly near term. Yep.
$64 a share. So if we're going, if we go at that, from going from $45.87 what it closed at to $64, I wouldn't complain if that happened.
Good stuff. Well, thanks. Well, let's go ahead and see if we do have any questions about either McGraw-Hill or Qualcomm at this point, and then we'll go to the next point in the program. Anything out there, Ken? I think it's an interesting story.
We're keeping up with the questions pretty well here, Mark. I just have to remember to keep myself muted when I'm typing. I'm sorry, folks, for that typing in the background.
You were actually a little more light-fingered than usual.
Thank you.
All right. Well, I think that's I guess that was good. I think it's an interesting story. You know, when you think about the quagmire that the educational stocks have been, that's no longer in the picture here. And I don't know, suing them over what happened during the ratings fiasco, that's not exactly news. And the government has not exactly wreaked havoc on anybody out there. So it could be very interesting to see what happens with McGraw-Hill.
The interesting thing is they're not suing Moody's, and Moody downgraded the U.S. government debt too.
Yeah,
so why are they picking on? And my thing is, isn't it amazing? You find out that you have $2.5 billion that they're getting for selling off a division. Are they just going after somebody where they see they got lots of money?
Yeah, good stuff. Thanks, Kim.
All right.
All right, let's go ahead and talk about Best Picture, and this is kind of our People's Choice Award for the session. Chance to add another statue. The previous winners of this award were in 2010, Ken Cavola and his now infamous Hogg's presentation on Chinese pulled pork that somehow linked Hungary to, wasn't Hungary, where was it?
Slovakia.
Slovakia, how could I forget that? Anyhow, linking Slovakia to China, it's awesome. Go back and listen to that one sometime. It's completely unfair what has happened to the price of hogs, H-O-G-S. And then in 2011, we had Hugh with his wrong end of the spear, more Spock, less Kirk presentation. And I just kind of went back and looked at some of the stuff that I've had comments from over here over the last year, and some of them are fairly recent. Ken Cavola, a couple months ago, presented Vera Bradley Across the Generations, and it had a lot of similarities to that Slovakia to China pulled pork story. A lot of charm, and I think Vera Bradley, even though it's slumped a little bit since then, probably a very good long-term, high-potential selection in another Hoosier company. Cy Lynch presented on multiple occasions Teva Pharmaceutical as his selection, and I've dubbed that one Across the Oceans of Opportunity, recognizing that they are a very global firm, but he also pointed out that they're developing business with Procter & Gamble, outstanding series of presentations, all supporting the case for Teva. Hugh McManus, again, various presentations. We just simply have to take a moment and say, every once in a while we shake our heads when he comes up with these, but when you go back and look at the performance of the combination of Bank of America, Staples, Walgreens, and Microsoft over the last several months and years, you know, most of us are left just scratching our heads, but scratching our heads in homage to a method of investing, if you really, really, really are committed and patient, can work out extremely well for the persistent. And then the last presentation I put up for nomination, we're going to vote on these here in a second, hence people's choice, is our favorite screens. Back in September, I went through and showed how we shop for opportunity across the universe of stocks that are available in the manifest database. And that presentation, again, not stock specific, but method or technique specific. So with that, Ken, if you're ready to release the poll, we'll ask the audience to go ahead and vote on, what type of presentation you seem to like the most. Again, Ken's Vera Bradley across the generations, Silentia's Teva across the oceans of opportunity, Deep Value with Hugh, and Favorite Screens, presented a few months ago. And if anybody wants to write in a vote with an audio vote, we can do that too.
While the vote's going on, Mark, I want to protest your role as the moderator and chooser of the nominations.
Oh, here we go again.
Favorite screens, and it is Best Picture. Are you trying to subliminally influence the vote or something?
Oh, leave it to the legal beagle in the audience.
Okay, so if we're protesting, do I get to protest something?
Yeah, go ahead, protest away.
Hey, it's not fair. I brought portfolio recovery to Ken's attention, and he gets the award. Not fair.
That is true. And in fact, Ann, you may recall, I pointed that out at the time of selection, that he was clearly jumping on the Manning bandwagon.
I know, and
I don't
know if that's fair. I get second place because I brought it to his attention.
He shamelessly took, he said he was willing to steal ideas wherever he has to go.
Exactly.
I'm just going to sit here and let him talk.
So how are we doing, Ken?
We do have 54% voting. I'll give you about another 10 seconds, and then I'm going to close this poll here.
Talking of recycling stocks, there's a certain drone company that I've been watching for a year that I will add to the portfolio at some point when the price gets whacked. Because that company has enormous upside, the AeroVironment.
Oh, absolutely.
Isn't that the one I presented last month, Hugh?
Correct.
Ah, okay.
I'm circling it like a drone.
Okay, great. And Mark,
So
it
he's
looks like
jumping on your stock.
It looks like you've taken home a winner here, Mark. Our favorite screens with 39% of the votes. Vera Bradley and Teva in a dead heat at 21%, and Deep Value not far behind at 19%.
Well, I just want to thank my grandmother, my mother, to start the music. No, we'll take that as a sign that you would like us to spend a few minutes talking about, even if it's just 5 or 10 minutes, some type of educational theme, and we'll try to work hard on doing that. So we'll attempt to take your vote and deploy it as best we can. So with that, it's time to marshal in Mr. Lemcool. And
is that Ken?
No, that is actually Herb.
That's Herb. We need to get Joan Rivers in on this real quickly here, Herb. Okay.
I think this is definitely a red carpet fashion violation of the worst order. And I have to say, I did the audience a favor. I left his legs out of the photo. He's bare-legged underneath there.
Yeah.
How you doing, Herb?
I think I have to explain that I'm in the Rotary Show, and we do a fundraiser, raise about $75,000 a year. And last year they decided that they needed somebody to play Tinkerbell, and my wife volunteered me. Who she's standing right.
She's right behind him. She's back here.
Yep. So and it was shock value, just like everybody else, I'm sure, is looking at that picture, shocked at that picture. So. But we did raise some good money, and we had a good time.
In all fairness, I have to take my hat off and salute Herb. For those who don't know, Herb is a civic champion up in the Traverse City area of Michigan, and he's been actually the leader of the Cherry Festival a few times, and he just does a lot of stuff for community. And We're just pleased to have you with us, Herb. And tonight, your selection, let's hear about Dollar Tree stores.
Well, you know, the reason why I chose this is because the other day we were driving down the road, and all of a sudden my car, or my wife's car, had this tug, and it was like it wanted to turn into this shopping center called Dollar Trees. And I asked her about it, and she said, well, you know, I'm not sure what I understand about that, but every time she goes by it, she has to stop there and go some shopping. So I think the car has got an automatic pilot in there that automatically goes to that part. So she's got a little bit of time in there, and so I thought, you know, I've been looking at this and looking at it, and I always thought it was a little bit too pricey. Well, now it's kind of dropped back down, and so, you know, their sales seem to be continually growing, their profits growing. If you look at the that particular chart, you can see that it's what we call in mid-Michigan up, straight, and parallel. Did I get that right, Ken?
I think you did, Herb.
Especially for a retailer. That's awesome.
Yeah. I mean, this is an excellent store. It, you know, when you start looking at it, it really sells a lot of things at $1, and that's their number one forte. They've got about 4,600 stores in 48 states and 5 Canadian provinces. And so this is a company that's been around a long time. They seem to know what they're doing and how they're doing it. It is a discount store, so it's you know, sells everything from groceries to paper products to you name it, and it's all, if you can buy them at $1, then you are. So, but if you can see this, their pre-tax profit continues to go up, and they're just doing an excellent job in that arena. And same thing with the earn on equity has escalated also. So, but their conference call for their coming out in March 12th, I think. So I think if somebody wanted to learn more about what's happening, you know, I would recommend that you get online and listen to what management has got to say about where they're going to go and why did they lose some of the. They really dropped from a high of 56 down to 40. So I'm looking at this as a possibility, a good opportunity to go in and buy, especially when our PE ratio is down to 14. So it's really coming on strong for the. So you know, when you look at a PE of 22 and now it's down to 16, and they're projecting it to be a 14. It's right now 14. So it's an opportunity, I think, for somebody who might want to look at this particular company. And then, if Mark, if you would go into your Eagle on that, you can see that it's done an excellent job. I didn't post an Eagle, but I figured you could pull one up if you had one there. But it's continually working its way into a major buy zone as far as I'm concerned.
Okay. Well, I don't want to jump out right now, but you can see the value line definitely agrees. And very strong trends.
Yeah.
Very strong.
It was interesting, though, that when I'm waiting for everybody to come online this evening, I went back to an old company that I had in my portfolio and sold, and I hadn't looked at it. And I think it's one of those things that we have to learn our lessons, that when we start putting things in that we sell, we ought to put them in our watch list to figure out what's going on. Medlar Toledo. Just absolutely blew my mind because I sold it, I think, at $150. It's now over $200 a share. That's a scales company, and so somebody else may want to look at that one also.
Thanks, Herb. So with that, let's go ahead and turn to Across the Oceans of Opportunity. Cy wants to renominate Teva tonight.
Well, thank you very much, Mark. Seeing that I didn't quite get the boost that I needed to win the Best Picture award, I figured that I would borrow from a couple of my competitors tonight. And again, repeat on Teva. The two competitors that I'm talking about are you, who through your subliminal messaging seem to win the victory, that being screening ideas, and Hugh and his deep value ideas. Where I got Teva this month, besides the fact, of course, we are pretty familiar with it. It's largely a favorite in our community of long-term investors, and of course I have picked it as my stock of the month several times. But also I decided I will go to wisdom of crowds and took a look at the heavy hogs portfolio on manifestinvesting.com for 2013, and the stock that happened to be in the top of the sweet spot, that being in the green, was Teva Pharmaceuticals. I also noticed, after I had already picked it, but at the close of the market today, it is sitting at the top of the sweet spot for all stocks covered by Manifest Investing, and it's basically right at the top for the roundtable portfolio as well. So all of those reasons kind of led me to pick Teva again this month. Now, taking the cue from Hugh on deep value, recall that Teva is a generic company, in fact the generic pharmaceutical company, the largest generic pharmaceutical company in the world, also with some branded pharmaceutical component, but the price has been pretty flat, as you can see, for the last several years on this graph, and in fact is trading pretty near a 52-week and in fact multi-year low currently, in large part due to concerns over its largest branded drug, Copaxone, which is a multiple sclerosis drug that is facing competition right now from orally administered MS drugs. Copaxone is an injected drug, so it's less convenient than an oral drug, and that has cut into sales, and it also loses patent protection in the next couple of years. Also, generic launches, which has been Teva's bread and butter over the years, are down. So both of those reasons have caused, as you can see on the chart that Mark is circling now, sales and earnings have been flat for the last year or so and are projected to remain flat for another year or so. On the other hand, because the PE has been punished so much, you can see that Value Line does see a low projected return over the next 5 years of 17%, with a possible upside to 23, and that's quite frankly with very little growth. Value Line has been quite pessimistic in their projections with growth going forward. Go ahead and flip to the next slide, Mark. Here are my judgments for Teva. Pharmaceutical sales growth of about 7%. I got that largely from taking a look at Value Line Morningstar's projections of potential growth over the next 5 years, as well as, again, companies' historical rate. Net margin of 17%, which you can see is a pretty good recovery from the current net margin, which is depressed at 9.3%. PE forecast, essentially the median over the last 3 to 4 years is what I picked to come up with the 14.5, which is a little bit of a decline from the trailing PE, and that gives a projected annual return of 19.7%. I'll just close by mentioning or answering the potential question, if, okay, Cy, if the branded pharmaceutical, their major branded pharmaceutical, which was a big chunk of their profits, is facing competition, and their bread and butter generics are down currently, where exactly do you see even 7% growth? And the answer is twofold. One, there is some opportunity a couple of years out in generics with some drugs coming off patent that Teva is expected to perhaps take advantage of. But primarily, the company is focusing on establishing footholds through joint ventures and acquisitions in developing markets, in the non-European and North American markets, such as Korea and places in the Far East. So they expect that they can perhaps experience some tremendous generic growth there. Mark mentioned earlier, as I've mentioned in previous presentations, the over-the-counter potential of Teva's joint venture with Procter & Gamble here in the United States. And then the final area, which is a bit of a wild card but certainly has tremendous potential upside, is the biosimilars market, which is, rather than the traditional pharmaceutical generics, taking and forming a generic form of biotech drugs. So those are the potential growth areas for the company, and that, coupled with a pretty decent dividend yield, I'm only showing 1.7% based on my projected increase in price over the years, but Value Line is showing right now, based on current price, a projected yield of about 3%. So it's a healthy yielding stock as you wait patiently for the price to appreciate.
Good stuff.
Cy, Jane Johnson from Western Michigan would like to know if you've factored in the $2.1 billion lawsuit from Pfizer concerning patent violations.
I was aware of that and actually did not do the math this afternoon myself. I was a little curious about that when I ran across it, but since both Value Line and Morningstar did not seem terribly concerned, I did not dig deeper. I'm just looking right now. That would be a fairly significant chunk. The current net for the company in 2012 was about $4.7 billion. So that would be about a 50% drop. But again, if you look at it as a one-time event, that's only a 50% drop in only 1 year.
Probably want to check and see if they may have reserves on. They may have some reserves also.
I would suspect that they do.
Mm-hmm.
And then Dolores would like to ask Hugh to weigh in for 30 seconds or so on what he sees as the state of generic drug growth for the next 2 to 4 years.
What a good question.
Generic drugs, legacy. Can you hear me okay?
You were dropping out a little bit,
We're hearing
Hugh.
you fine, Hugh. Go on.
Okay.
Go ahead.
So there is a patent cliff facing all the major pharma companies. Eli Lilly is one that will differentially be impacted by it, but Pfizer not as much. But many of the big guys are going to be whacked by that. Patent cliff means that things go off patent, so that's an opportunity for companies such as Teva to increase their portfolio with these newly minted types of drugs. They can file the necessary paperwork with FDA to get marketing approval. So that's good. But the other area, as Cy kind of talked about towards the end of this talk, is in biosimilars. This is a brand new area. It's almost uncharted, at least in the U.S. It will be very interesting to see what happens there, and certainly Teva, compared to many generic manufacturers, has a major leading role in the ability to produce biogenerics once the regulatory environment straightens itself out a little bit. And the interesting thing, too, is Teva has pretty deep pockets for a generic company. So if there is a requirement to do something more than what you have to do for small molecule generics, aspirins, Lipitor, things like that, if there is the requirement to, say, do at least a small-scale clinical trial for efficacy and safety, because these larger molecules are quite complex, then Teva is probably in a better position than most to actually do that. So I would say of the generic companies, even though that things don't look good right now in the sense that it's not like it was 5-6 years ago when the top line was rocketing, I think they're in a much better position than many of their peers.
Good stuff. Well, thanks, Cy.
Cy, could you once more tell us your justification for that 17% net margin number?
Certainly. That is essentially a return to just below the 5-year average from the current depressed state that it is right now as far as on a pre-tax basis. And then applying value lines, 15% tax rate gave me the 20% pre-tax or net margin. I believe that may be a little more, no, actually it's a bit smaller than value lines. Both value line and Morningstar project an increased operating and net margin for Teva going forward, and I essentially bought into that with the exception that I used, like I said, kind of as my baseline recovery being the 5-year average.
Well, thanks, Si. We probably better press on. We will stick around for extended Q&A when we officially adjourn, but let's go ahead and get our final couple sections in. Ken, why don't you go ahead and take it away with another healthcare-related company, U.S. Physical Therapy.
Well, last month I made the statement when I chose Aero Environment that I was looking for small companies that had a little bit of untold story, and that I thought were going to become pretty big stories in the 5 years that are going to come in front of us here. Another company that's small right now that I think might fit as an answer to that question is this U.S. Physical Therapy. My daughter is training to be a physical therapy assistant, and she and I have talked at length about the fragmented nature of this particular industry. Now, these are the people that you go to when you're trying to recover from surgery, when you've had an athletic accident, when perhaps your knees just aren't working the way you thought they should be working as you get older. These are the folks that have a market that is just increasing with the demographic of the baby boomers as they age, using more and more of their services. This particular company has a presence in almost every state in the union, 42 of them right now, as you can see. And there's quite a few clinics in some of the states, and it's a very fast-growing company. What interested me was that there's a $10 billion market in this physical therapy segment, with about an estimated 5% projected annual growth. Demographics certainly favor it, not only with the aging of the population, but with the fact that the population is becoming more physically active. As we begin to stress activity, we begin to stress obesity, we begin to encourage people to get up off the couch and move around a little bit. Notice that this market is extremely fragmented. There's about 16,000 clinics throughout the U.S. doing these outpatient rehabilitation kind of services, and no company controls more than 6% of the market share. U.S. Physical Therapy is the third largest chain in the country, and the first two chains on the list are not publicly traded companies. So U.S. Physical Therapy is the largest publicly traded company trying to put together a national franchise. They operate under a myriad of brand names, and you can see some of these brand names around this graphic right here. You can also see that they're continuing to open clinics, a couple up in Washington, 7 in Pennsylvania, a couple in Maryland here. So there is growth, good growth going on in this company on a regular basis. And I also like the fact that their revenue stream is coming from many, many different sources. A lot of times when I look at some of these medical companies, I find that their revenue stream is coming 90% plus from Medicare and Medicaid. This isn't true of this particular chain. They are getting more than half of their more than half of their revenue is coming, but not from Medicare and Medicaid. It's coming from private insurance and managed care. About a quarter from Medicare and Medicaid, a little bit less than a fifth from workers' comp, and the rest from assorted small inputs into the revenue stream, but there's not a dependence to a great degree on the government funding these clinics here, although under the new healthcare system, I think everything is open to interpretation. Let me take a real quick look at the stock selection guide for U.S. physical therapy, and you know, I like what I see, especially in the last 2 or 3 years. There's been good, steady, consistent growth, and there seems to be a moving together of the green line and the blue line, which indicates to me that the management's getting expenses under control. When I turn this thing over, I see that there's a really nice trend in pre-tax profit margin in the right direction. It's moving in the right direction, and return on equity is where I would expect it to be for any company. These are minimum values that I might expect, but again, they seem to be moving in the right direction. I'm looking at what I think are fairly reasonable PEs, and I do think that the high side, it can recover to an average somewhere around the last 4-year average of around 20. I think 11 is a fair number for the last 4 or 5 years, or the next 4 or 5 years going forward. And when I do that analysis, I'm getting about a 12% par, which comes very close to matching the manifest number, and that gives me a lot of confidence in my stock selection guide when I find myself coming so close to the manifest number. So I'm going to submit for the portfolio this not very small, but reasonably small stock, U.S. physical therapy. I'm suggesting growth rates of around 15% going forward. Let's watch it for a couple, 3 years and see what happens with it. Thank you.
Sounds good. Thank you, Ken. Why don't you go ahead and switch it back to me, and we'll close out. Hugh, would you like to spend a couple minutes on your repeat selection of Microsoft, and then we'll close things down with the last awards?
Well, yeah, as you know, I'm going to go for Microsoft again. By the way, you mentioned creaking in the background. Did you hear it a second ago with this chair?
Yeah, we did. Maybe it's the chair?
Yeah, maybe I need to oil this chair. Or lose weight, or both. I don't know. But yeah, I mean, it's interesting. Well, for those that are attending, one of the things that we do prior to having this meeting is to try to plan things out so we don't run over. And that doesn't always work out, as you may or may not have noticed. So they were looking for volunteers this week not to present and not to send slides. So this time I volunteered. As it turns out, I didn't have any slides, and Mark kindly offered to provide a background slide for Microsoft, which is the selection that I've picked now twice in a row, I think. One of the drivers for me is I tend to look at companies, good companies, by the way, that I think have a long-term future, but whose stock price is at or near its 52-week low. And Microsoft fills that criterion. It's now close to 20% of its 52-week low. See, I'm a presenter, but as I said, Mark, I just don't have the slides.
Oh,
I'm just kind of surprised.
Ken, did you switch it?
We're not only on time, but we're ahead of time. Because I remember last year we ran out of time almost completely.
Ken,
but the bottom line is, sorry?
I have Ken switch it back to me.
Okay.
Oh,
Mark, the reasons for picking Microsoft actually haven't changed since the last month, except the price, I think, is just a slightly lower. It still has a very good annualized return.
Yeah, and here, I guess if we could just get just a quick comment from you on this. I mean, many people in the audience fit the bill of this thing has been in the trading range for now basically 10 years, along with most of the S&P 500. You know, from your investing experience, I mean, here we have this earnings line clearly, you know, up and to the right, while the P is stuck. I mean, isn't this one of them that one of these days could take off, much like Cy was talking about earlier?
It certainly could. One of the risks, of course, of a technology company, as I pointed out before, is that the innovation cycle changes a lot faster than the financial reporting cycle. So somebody could come on the horizon with an Office-type product and just blow Microsoft out of the water. Could it happen? I don't know. developing an operating system is a complex enterprise, and you can actually see firsthand that when people do this in these volunteer groups for packages like Joomla and things that run websites, it takes a lot of people and it takes a lot of effort. Microsoft has stumbled on some good opportunities. I knew the Xbox is a very good example. It was late to the tablet market, but it has produced a nice product with Surface. It's surprising to me that it missed the cell phone market entirely, because for many of us that was literally staring us right in the face.
Sure.
But you know, it's a company that is a slow entity. It used to be lean and nimble, not anymore, but it still continues to grow, as you see on the top line, at a pretty steady clip. If I were Microsoft, and Microsoft does this, it certainly acquires other entities, but it also funds other discovery entities as well. And just like Big Pharma, that's perhaps where it's going to find its innovation, because it's not that good at doing it in-house.
Yeah, and they have a fair collection of cash also. All right, so we'll go ahead and add it to the repeat selection. All right, let's go ahead and move on. We'll wrap up for tonight. We're going to have our last awards, and then we'll have the audience vote on the five, because we left Microsoft out of it, the five stocks that were presented, and do the audience selection thing for tonight. So let's go ahead with the best performance in a leading role. And again, you see some of the history there among the highest accuracy for given years. And for the year 2012, the award goes to the guy who needs more room on his mantle, Hugh McManus. He had quite a year with Bank of America and Staples and Walgreen. Wow. And he's helping boost the overall accuracy of the entire round table, and we appreciate that. In the all-time slot, which basically is not just 2012 but all 3 years, that is still Ken Kavula. He has the highest percentage of outperforming selections over the entire 3-year period. So congratulations to both of you. And now we'll go with where the rubber really meets the road, the highest relative return. And now we do have to make an editorial comment here. I'm sorry, Hugh, but let's just say that Hugh is not in the lead a majority of the days during any given year. And what we have noticed over the last several years now is, for some reason, he appears to assume the lead, usually within a week to 10 days of giving awards. And then he typically is reseated, and then somebody else pulls into the leadership position. Well, he did it again this year. If you go back and look at Bank of America and Staples, the price action over just the last couple of weeks, it's like a skyrocket. And at one point, he was it's just phenomenal. And it's wonderful, because we all take collective credit for these things happening, but we actually had an executive meeting about this, Hugh, and we want to know who you know and how much you're paying them.
Well, it turns out I own a time machine.
Because basically for 2012 you knocked it out of the park, and that is plus 14% relative return. That means his annual return was 30-something. And the all-time, he has managed to pull into that. I will note that even despite this rocketing surge that he's had, Ken is only a 1/10 of a point behind him in the all-time standings. And again, it is a group effort. We are grateful that we are all in that 0.5% to 1% all-time positive return collectively. And that includes the damsels and the guest knights and the audience. And pretty good stuff. We think we're all headed in the right direction, and look forward to future awards. And Hugh, if you wouldn't mind taking a year off eventually, we'd appreciate it.
Okay, Mark, do you want me to launch the poll now for our audience choice?
Yeah, let's go ahead and launch the poll. Here I've summarized the 6 selections. If Ken launches the polls, I don't think you can see these, but go ahead and vote for the stock of your choice. Again, if you're joining us for the first time, we encourage participation in these things. Go with what your gut says, even if you haven't had time to study all 6 of them. Cast your vote for your favorite.
Those of you who are groundhogs out there, remember that I chose Teva based on your picks. So please be consistent and keep voting for Teva.
Oh, it's a bad sign when he's passing the buck early in the year.
all you have to do is use your cursor and press one of the dots on the screen, folks, to vote. We're up to 80% voting. I'm going to hold it open for another 10 seconds or so. So this is just fun. So take a chance and pick something.
We don't write your names
You're
down.
not going to destroy anything, right? We don't keep track of this.
We don't log your votes much.
And let's close the poll. And I'll share the results. And Anne, Qualcomm has been chosen by the audience. U.S. Physical Therapy, a close second, and then Dollar Tree and McGraw-Hill tied for third, and Teva in a fourth place position here. So we will buy another position in Qualcomm as well.
And let's hope for another PRAA moment with Qualcomm. Good portfolio recovery.
Okay, and I'll hide that, and Mark, you can continue now.
All right, well, the continuing is just going to be to basically say goodnight. I want to thank all of you, including our guest damsels, Ann and Kim, Herb, and Herb, we appreciate you sharing your tutu with us. But, thanks to all the knights of the table. Congratulations to the statue awardees. And again, thanks everybody for your participation, and we appreciate it. We'll be back about a month from now. We will close down the official broadcast and continue with a little bit of Q&A for those who would like to do it. But with that, we'll all say thank you, and good night, everybody.